Hey guys, how's it going? After a lot of thought into what topic should we select for this video, I have come up with an intercompany stock transfer process. So we are going to compare about a trade process or a trade sale, what we also call as a third party sale, with a stock transfer, which is an intercompany stock transfer. So we'll understand what is a primary difference between a trade and an STO or an intercompany sale. And we'll also see in the system already posted document which shows us a difference in the accounting treatment and also the steps that we follow in creating a normal sale and a stock transfer. So before we go into the video, if you are finding our videos useful, please do like it, share it, and subscribe to the channel if you haven't done it yet. A small subscribe will take us a long way to create a lot of videos. And if you're really interested to contribute to our work, you can join the channel by clicking on the join button right below this video, or you can also do a one-time contribution by clicking on the super thanks button. If you join the channel, you are going to get in return a lot of discount coupons whenever you want to purchase any video, be it from Udemy or direct purchase from us, or even when you are joining any online training batch. You will also get access to member exclusive videos like the Copa series, which is available only for the premium members of the channel. And we'll be posting many such videos which are member exclusive in future. So let's jump into the video. So first let's start with some introduction. We'll understand what is a trade and what is an intercompany a bit more. So trade or a third party, typically in the projects we call it as a trade sale. It can be a trade payable or it can be a trade receivables, which means it can be a sale or a purchase. This trade transaction happens with a third party business partner, which means that we don't have any tie up with that or we don't have any relationship with that customer or a vendor. It's completely out of our organization. On the other hand, the intercompany sale is between two entities that belong to the same company or a group of company, which means it can be two different company codes within the same group of companies. That means in an SAP enterprise structure, there can be two company codes that are assigned to a single company, and that is an intercompany transaction. Similarly, we can also have an inter-profit center transactions, which can be within the same company code, but between two different plants that are belonging to two different profit centers. Again, a separate concept, but that is a primary difference between a trade and intercompany or a third party and a intercompany transaction. So, what is STO? STO, as the name says, it's a stock transfer order. We typically call it as a stock transfer process, or people shortly refer to it as a stock transfer or an STO. So it is a type of a transaction which is a combination of both sale and purchase that happens between two different entities. It can be a plant, it can be a company code, but two different entities that belong to the same company. That means intercompany in short. So any kind of a sale or a purchase transaction happening between intercompany is called as a stock transfer order. So what exactly is the difference between a third party sale and an intercompany transaction? Why are we differentiating it into two different buckets? There are two major reasons why we differentiate between a third party and an intercompany. One, from an accounting point of view, and two, the steps or how we record these transactions in the system. Of course, from a logistics point of view, there are quite other differences as well. But in this video, we will focus on the accounting differences and how we record these documents, which is a way different than how we do a typical third party sale or a purchase. So let us take an example of a third party sale or a purchase. What we typically do is, if it is a third party purchase transaction, then we book the purchase order. And the sales order is not something that we book on our side, but it is booked by our vendor who is selling us goods in their own ERP system. Similarly, if it is a third party sale transaction with a customer, we record a sales order in our SAP system And the customer in their books or in their ERB will record a purchase order for this transaction. So in either case, we are booking either a purchase order or a sales order, depending upon whether it is a purchase transaction or a sales transaction. And if it is a purchase transaction, we follow typical P2P cycle, like how we post different documents and what is the accounting treatment. It all follows the standard P2P cycle, which is the procure to pay cycle. And if it is a sales transaction, we follow the O2C cycle, which is the order to cash cycle. If anyone has a confusion about P2P cycle or O2C cycle, search for the videos on my channel and you will get it for sure in some simply explained terms. So this is a third party sale or a purchase transaction above. Now coming to the intercompany, because intercompany is between two different entities which are belonging to the same company, and moreover we are having these two company codes created in the same SAP system, which is majority of the cases, we record both purchase order, or that means the purchase side of it, and we also record the sales documents or the billing document, etc., for this same transaction. That means for a single transaction, we are recording both the sales aspect of it as well as the purchase aspect of it. That is a primary difference between how we record the documents or how we post the documents for a typical third party sale or a purchase and an intercompany transaction. And moreover, in intercompany, because we are worried about both the purchase aspect of it and the sales aspect of it, the accounting treatment is a bit different when we see how what are the GL accounts that are picked, etc. And in the intercompany transaction, we do not follow a separate P2P or a separate O2C, but it is a combination of both P2P and O2C cycles. It's a mix of these two approaches. It's not like a P2P cycle and an O2C cycle happening separately, parallelly to each other, but this is a mix of P2P and O2C, which we will understand in the subsequent slides. So this is an example of a typical trade sale which follows a O2C cycle, order to cash. We post a sales order in the system and then the SD team will create a delivery for that. And at the time of delivery, a goods issue is created, which means a post goods issue is done, which is having accounting impact. Inventory is reduced, so inventory is credited and the COGS account is debited. And after that, a billing document is created for which an invoice is posted and we have the customer debit and the third party revenue is credited. This is a typical O2C cycle. And next, if we see a typical P2P cycle, we have a purchase order and after that, a goods receipt is created in the transaction MIGO, which has a financial impact. Inventory is debited and the GRAR intermediary account is credited. And after that, we use the transaction code MIRO to post an invoice. And we have vendor credited and the GRR account debited. These are two separate cycles of P2P and O2C that we do in a typical trade transactions. That means a third party transaction. But if we see an intercompany transaction, it's quite different or a mix of P2P and O2C cycles. That does not mean, as I said, we run both P2P and O2C in parallel, but these two run together so that there is a difference in how the accounting treatment happens in case of an intercompany. So the very first thing is the receiving entity, whoever is requesting for the material from plant A to plant B, let us say suppose. Plant B is the one that is requesting for some material and plant A is the one that is delivering the material. And plant B belongs to company code B and plant A belongs to company code A. So the purchase order is raised by the company code B, which is the receiving entity. This is the receiver. So the sending company code, which is company code A, is created as a vendor in the receiving company code. And against that vendor, intercompany purchase order is created. And unlike typically after creating a purchase order where we create a goods receipt, here in this case, we post a delivery in the sending company code against the purchase order that is created in the receiving company code. So there is a link between the sending transactions and the receiving side transactions. Though these are happening in different company codes, there is a quite clear integration between these two company codes, and obviously that is why we call it as an intercompany transaction. And the purchase order which is created in the receiving company code is delivered by the sending company code without creating any sales order. So in this case, unlike a typical trade O2C cycle where a delivery is posted against a sales order, in this case we don't have any sales order. We have a purchase order, and against that we use the transaction code VL10D or VL10B to post a delivery, and the delivery accounting treatment is same as normal. The inventory is credited and the COGS account is debited. Now, the difference between the accounting treatment in case of a delivery in intercompany is that here we have the accounting treatment for both goods receipt as well as delivery, which is posted by only one transaction, which is a delivery. So the moment we create a delivery document against the purchase order, it is posting the accounting of a typical delivery where the inventory is credited and the COGS account is debited. But in addition to that, we also have a treatment of the receiving side, which is the goods receipt, where the same inventory which is flushed out of this sending entity is received in the receiving entity and the inventory is debited and the GRAR account is credited. Now, once this delivery document is posted, as I said, this is posted in the sending company code, but these two documents are created as intercompany documents. This first document is created in the sending company code, and the second one is created in the receiving company code. So these are intercompany documents. After that, we create a billing document in the sending company code. That means company code A. Against this delivery, we go to the transaction code VF01 and create a billing document which has a typical transaction receiving plant, which is the customer, which is created in the sending side. The receiving company code B is created as a customer and company code A, and that company code B plant is debited and the intercompany sales revenue is credited. After that, there is a typical way of using IDOCs. The moment we create a billing document, an IDOC is triggered and that IDOC is used to post the invoice on the receiving company code directly, which is a vendor invoice. Or we can also have a manual invoice posted via Miro. It all depends on the configuration. So this vendor invoice is posted on the receiving company code where we have sending plant, which is the company code A credited and the GRIR account is debited. So this is how the intercompany transactions differ from a typical P2P cycle and an O2C cycle. So I hope you have understood about the differences in the accounting treatment between a trade transaction, a third-party transaction, and an intercompany transaction. In the next videos in the same series, we will see how the documents are posted in the SAP system, and we will also see the configurations that are required for the intercompany transactions. So see you in the next video. Until then, take care.